Okay, what is up, and welcome back to another episode of How to Invest in Commercial Real Estate. And today we have a super exciting show. It's about taxes.
So exciting.
Woo!
Love taxes.
Now, why are we going over taxes again is because in your lifetime, the biggest expense you'll have is paying taxes. It doesn't really matter what job you work. And so it makes sense if you want to make more money to reduce the biggest expense you have. And real estate is one of the best ways we found to be able to do that. So today we're going to go over 8 strategies that people can use to either lower their tax bill or pay 0 taxes.
Right.
Hit us, Brian.
Number 1, self-directed IRA, or invest through your IRA.
Yeah, so this is an easy one, obviously, because you can use the self-directed IRA to kind of defer taxes for pretty much anything, right, that you can invest through with your self-directed custodian. But real estate is also one of those ways, and a lot of people don't realize they can invest directly into an LLC, a private LLC, exactly how we buy real estate, and use their self-directed IRA. Every single time I've told somebody we take retirement money, their mind is blown. They're like, oh man, I kind of forgot about my IRA or whatever it is.
And I have a question. You know, I know when you leave a job and you have a 401k,
Yep.
you can roll it into a self-directed IRA, and that gives you flexibility on which investments you can invest into. So when you're at a company, they may offer you a range of mutual funds, stocks, bonds, all of that stuff, and then you're pretty limited in what you can invest in. But when you leave that job, you can roll it over, and then you can invest in pretty much anything. Is there another way to get to a self-directed IRA that you can invest in real estate?
You just start one.
Yeah, you can just start one.
Okay.
You can start your own.
You don't need no company.
Yeah.
Yeah, but it may be different in that what are the tax advantages? Like 401k, it's tax-free money in.
Correct.
But an IRA, you're gonna don't you pay taxes?
An IRA is post-tax, or you don't, like an IRA is taken out pre-tax, right?
You can have a traditional IRA. You can have a Roth IRA.
Yeah, so a Roth IRA, you can withdraw the earnings completely tax-free.
Because you've already paid the
tax.
But
on the
so
money.
which one do you have? Is there one or the other that you have to put your
A 401k, a traditional 401k, and a traditional IRA. You can have a Roth version of both,
Yeah, right.
but you pay the tax on the way out, I believe.
Yeah.
Yep.
Okay.
Anyway, so if you've left your company and you have it, you've left your 401k sitting with your old company, you're going to want to consider rolling that into a self-directed IRA. You can still keep the same mutual fund investments, but at least it gives you the option to look at real estate. And not just us, many investment syndicators have the option to use those self-directed IRA funds and invest in our real estate deals.
Okay. Is there a downside to using an IRA? Can you use all your deductions in a self-directed IRA like you can through a if you weren't going through an IRA?
Yeah, so you don't get any extra deductions. I mean, it can offset whatever else is going on in the IRA, I believe. Maybe not. But
it can't offset anything outside the IRA?
no.
Okay.
No. And the biggest note on IRAs, or really any sort of tax-deferred retirement account, is you want to be putting your highest taxable events in there. So whatever that is, I would use that first, right? Because you're constantly deferring the taxes. So right now, our development deals, right, where we're in and out of in 18 months, we may not have a tax return with a full depreciation from a building, just because by the time we finish construction and sold it, that may be before the end of the second year. So that would be, that may be a decent taxable event. It's not like a long-term hold like some of the others.
Yeah. Anyway, consult your financial advisor, whoever's got your 401k currently, or if you've already rolled it into a self-directed IRA, and ask them about potentially investing in commercial real estate. Next.
Okay. Number 2 would be hold your property for more than a year. Why do we want to do that?
Yeah, easy. Braden.
Moves into long-term capital gains.
Yeah, so your income is short-term income taxed, and so
Ordinary income.
And anything you invest in that you sell within 12 months is treated just like income from your job, which is the highest taxed percentage that you can pay.
likely.
So just to
Most likely.
confirm, a job, a W-2, a 1099, ordinary income.
Or any investment you sell, you hold for less than a year, will be treated like ordinary income and taxed at that level.
Gotcha. So we're immediately getting a tax break by just, if you make money that you didn't work for, it sounds like, right? Because anything you have to work for, you wouldn't be paid over the course of, longer than a year, right? So you're immediately getting a tax break just by being an investor, it sounds like.
I would say most people that have the financial wherewithal to invest in commercial real estate are already paying, or already in a tax bracket with their ordinary income over 20%. So any investment opportunity you hold for longer than a year, you're going to sell that and you would be paying long-term capital gains, which is at 20% currently. And so it's a great way to save, especially for high-income earners, doctors and lawyers and CEOs and business owners. You're going to be in the 30-40% tax bracket. And so wouldn't it be great if you could earn equivalent income and pay half the taxes?
Well, depending on how much it is, it could also be 0% capital gains, taxes paid, or it could be 15%. But over a certain amount, it's going to be,
that's right.
It's going to be 20%. Okay, next is live in the property for at least 2 years.
Yeah, I debated putting this on the list, but a lot of people ask us, how do I get involved in commercial real estate? How do I create the nest egg? Where do I get the initial funds? And I think some people know this, but not everybody. Is single family home that you live in. If you and your wife, let's say you're married, or your significant other, live in your home for more than 2 years, and then you sell it, the gain up to $500,000 is tax-free.
Woo!
Okay? That is amazing, people, because there's a lot of markets where houses are going up in value pretty fast. Maybe not as much in Oklahoma, but in some of the growing states like Texas or California or New York. And so that could be one of your strategies to build a nest egg to invest with us is, buy a fixer-upper, right? Fix it up, live in it 2 years, flip it after 2 years. Let's say you make $350,000 on that house or $150,000 on the house. 0% taxes on that money.
Which is, 150. Let's say you made $150,000. That's like putting $30,000 in your pocket. Easy.
Yeah.
Easy.
That's right. And you can do it again. So let's say you take that money, you can roll it into the next house, live in that another fixer-upper, another 2 years.
But the limit is once you reach $500,000
each time.
Oh, you can do it each time.
Okay, consult your tax professional, but I think each house that you live in over 2 years,
yeah.
you can make up to $500,000 on that home and not pay a dime of taxes.
Yeah, I wonder if you could file separately, and a married couple could go up to $1 million.
No, it's $250 per individual.
It's $250 per individual. So
Yep.
that's your $500,000.
Yep.
So this is actually my favorite point, I just realized, because I think this is the point that really unlocks all of the tax advantages for a traditional limited partner. And here's why. A true limited partner that is not considered a real estate professional on their tax return is not able to always use all of the depreciation they have access to on their K-1 because they can only use, they can't go negative and they can't offset their active earned income with their passive depreciation and losses. Exactly. But once you have this fixer-upper that you're living and fixing up and trying to rent or sell or whatever it is, that pretty much makes you a real estate professional. And in my consideration,
pretty much, in his professional opinion, living in a house and fixing it up makes you a real estate professional. I think we need to ask an accountant about that.
You do. I'm just saying it's worth the question, right? Because a lot of people have a lot of depreciation that they can't use because they're not a real estate professional. So finding things to do in real estate to get those hours in for the calendar year to again prove and earn the real estate professional designation can save you a ton of money on taxes.
It has to be a lot of hours though, because the IRS says you have to spend at least half of your time in your business on real estate, right? So if you work a 40-hour job, your real estate's going to have to be 20 hours a week. So
yeah. So that's a separate point.
Could happen.
But it's a valid point to consider and consult your tax professional.
All right. Number 4 is 1031 exchange.
We've covered this ad nauseum before, but we had to put it on the list because it is one of the strongest tax advantages in commercial real estate. And so we'll just go over it again really quickly. You buy a property. Let's say you buy a $1 million property, and you own it for a few years, and you sell it for $2 million, and you're like, I don't want to pay taxes on $1 million.
I say that.
Anybody should say that.
Yep.
So how do you get out of paying that? All you do is you take all the proceeds from that sale and you buy an equivalently sized or valued property or bigger with that money. That's it. So if let's say that you had a loan on your $1 million property, you owed $600,000, so you were walking with $400,000 plus the gain of that million, so you're walking with $1.4 million. You go buy a $3 million building with it. You can eliminate the tax bill on that $1.4 million.
So there's a lot of rules and regulations and things you have to go into, and you have to use an intermediary. So
We've covered it in another show.
That was quick, but make sure to go watch the other show on 1031 exchanges if you haven't seen it, instead of just like, oh, he said you could just sell a property and go buy another one. You don't have to pay any taxes. Joel Thompson said that. You can hear it now.
No, but it's very, very powerful, and it works on a $100,000 property, and it works on a $100 million property. There is no limit to the 1031 exchange if you abide by the restrictions and the rules governing that part of the tax code.
Yeah, and it really makes the real estate investment treated like a 401k investment or something like that, to where it's allowed to cumulatively grow.
As long as you're not taking the money,
as long as you're not taking the money, which is a beautiful thing. I always kind of wondered why they set up these rules, and it's really, I mean, it's got to be to get us more money so we spend more money and put it back into the economy.
That's right. Or investment money out there.
Okay.
Supporting the businesses and
all right,
the economy in general. Number 5 is to maximize all your deductible business expenses.
Okay, I like this one because when I was first starting out and I wanted to be a real estate investor, I was starting to look at properties, but I didn't own any real estate, and I actually didn't have any real estate income. So does that mean I can't deduct expenses? No, he says. And so, as soon as you decide you want to invest in commercial real estate, okay, there are massive deductions that you can start taking.
It sounds like you just started a business venture when you decided that.
Yeah.
Right? You did.
And so here's how it goes is, let's say that you decide you're going to invest in real estate. And so what are the first things you do? You start driving the market. You start looking at properties. You start talking to brokers.
Mileage.
And so, I'm going to go through a few that just come to mind. What we want to try to do is take ordinary expenses that you're already paying, and we want to convert those to deductible expenses because you're now a real estate investor. Mm-hmm. And so let's say your cell phone. You need your cell phone in order to locate properties, to call brokers, to look up properties online. And so you can deduct your cell phone, you can deduct your internet, you can deduct newspaper, subscriptions, online subscriptions to different websites that'll give you information on commercial real estate, your car expenses. Here's one. Let's say you want to go to Dallas with your wife for an event. Well, you need to set up to look at some properties. Maybe there's some real estate in Dallas that you really want to buy. Maybe you set up a meeting with a couple of brokers to learn the market. Mm-hmm. Well, now you've got travel expenses, hotel deductions, all of those that you would have spent otherwise.
Lunch. I think dinners. You're allowed to do first round, last round. I mean, you're allowed to write off an obscene amount of things.
Yeah, with meals and entertainment, it's 50% of the expense, but with the travel expenses, it's 100%. So once again, you have to get good advice from your tax accountant to make sure that you do it the right way. But this is a great way to start getting deductions on your ordinary income before you've ever bought a property and before you're ever making income in this new venture that you're trying.
Yeah, and I want to rephrase the last part of that because I've never met a CPA that loves to give advice, right? You have to go in armed with questions and pressure them to help you with these things, right? Give them a copy of all of your expenses and say, I really need more write-offs. What can I write off? And press them on, why can I not write this off? Why can I write that off? Ask questions to your CPA. Almost always gets you more write-offs. Just asking questions.
And look, when I started in 2002, 2003, in order to get all of this information, I had to read 7 different books, okay, on all the tax strategies and all the deductions and all the business expenses. But now you're a Google search away from getting all of this information. So when I say consult a tax professional, I don't necessarily mean set up a meeting with a CPA. I just mean get online and do your research and understand the nuances and the technicalities of the tax code and make sure you're maximizing this. Because once again, taxes are your biggest expense. 25, 30, 40, 50% of your income. The government's taking that. And so we want to minimize the biggest expense we have. And this is the best way to do it, these ways that we're talking about. So,
all right, number 6 on our list is to depreciate your properties.
All right, Braden, hit it.
Well, we not only depreciate properties, we accelerate the depreciation on those properties because $1 today is always better than $1 tomorrow. And when you're paying the depreciation back, when you sell the property, it's what, 20%?
25%.
25% is depreciation recapture, which for a high income earner, that's a decent tax rate, right? And you get to write it off and not actually incur the expense. So a lot of times for the first several years, you're able to cash flow these properties and distribute that cash flow to the investors from those properties but write off this expense that you're not incurring, depreciation.
And remind us what accelerated depreciation is.
Accelerated depreciation is just changing the schedule. So a typical depreciation schedule is 27 and a half years or 39 years.
One of those two, yeah, depending on commercial, residential.
Yeah. So when that's a long period of time, and it's typically flatlined or however it is. So we go in. You can do a cost segregation study. It's $1,500, few $1,000 depending on the size of your property, and it basically just front end loads the depreciation. So you're able to take 20% of the depreciation that first year almost. A lot of the times, actually, you're able to take up to 20% of the allocated value to the building, which is typically 70%, I would say is a good number to say, because you have to allocate something to land and you can't depreciate land. So 70% of your purchase price is typically allocated to buildings, and then you can get 20% of that typically written off the first year, regardless of what day you bought it in the calendar year, which is a beautiful thing. You could buy it the last day of the year and write off 20%.
And, it's going to be hard to just describe how powerful this tax advantage is, but this is one of the strongest kind of this, along with 1031, is kind of some of the strongest tax deductions you can possibly have. We use it, and it allows us to make a lot of money with commercial real estate and not have to pay federal income tax because of this rule. We're buying really large buildings, and we're accelerating the depreciation, and that depreciation those first few years is higher than the income that the properties are producing. Yes. So not only do we get to write off all of the income the property's making us, but then we have this leftover depreciation that we can use to offset other income, okay? And that's how powerful it is. So if you buy enough property and you have enough depreciation, you can offset all the income you have. Now, if you are not a real estate professional and you don't do this full time and you're just investing passively, then you're not going to be able to use that depreciation to offset your active earned income from your job, okay? That's a whole nother show on how to get to do that. But it still accumulates. So let's say you're a passive investor in one of our investments, and let's say it generates $2,000 a year in income for you, but we give you $4,000 of depreciable income. That means that $2,000 write-off. And so that means that $2,000 that we paid you, you're going to pay $0 in taxes on that. But it's even better than that, because you're going to take that extra $2,000 and that's going to roll over to the next year. Okay. And so you save that depreciation, and if you have income next year, it's going to allow you to write that income off and not pay taxes on it.
Yeah. So I mean, most small businesses, so a business under 250 employees, that's most businesses in the United States. Most of those businesses don't have a lot of assets. They don't have a lot of depreciation. So their only way to offset income is to actually incur an expense, is to actually spend money. That's why you see everyone buying trucks at the end of the year. Oh, new truck, gorgeous. Oh, I had to. My accountant said I had to buy a truck. I'm so sick of that. Like, buy a building. Like, you don't have to actually incur an expense to get a loss. Real estate is the perfect proof of that.
That's a great example. So yeah, you buy a truck, you get the truck and you get the write-off, but you had to buy the truck for $70,000.
Yeah.
But if you buy a building for $100,000 or $1 million, not only do you get the write-offs associated with that, but you get the income the building gives you.
And your $1 million is still there.
So the building could, if you bought $1 million building,
appreciate instead of a car that's going to depreciate, right?
Right. So you buy $1 million building. Let's say you buy it cash and you make $100,000 on it, right, in cash. But you're not going to pay a dime on that because you're going to depreciate it. Mm-hmm. And the building's going to go up $50,000, $100,000 in that year. Yeah. So you're winning on all fronts and paying zero taxes while you do it.
Stop buying trucks
buy buildings.
Like, a lot of people need a truck. I get it, right? But there's better ways to get write-offs. So this is one of them, right? This is one of the beautiful ways. This is one of the best things about commercial real estate is depreciation.
Okay.
Eventually, you will depreciate it to zero, and I think this may be the next point, right?
Well, I got a couple of things to say about this. So,
okay,
you depreciate the building down to zero or down to some number.
Sure.
When you sell, if you don't 1031 exchange into a new property, then you're going to have to recapture that depreciation, and you're going to pay 25% on that. Mm-hmm. Now, two things about that. First is you're most likely in a higher tax bracket than 25%, so it's still a benefit.
Yep.
But the better thing is this. You may not sell that property for 15 years, right? So you get the tax benefit for 15 years before you ever have to recapture it.
To cumulatively grow your wealth.
Yeah, so now you're growing your wealth. It's like a 401k. The money goes in tax-free and grows tax-free. That's kind of like this is.
Exactly.
Is that you're going to get all this money tax-free, and you get to reinvest and double it and grow it and double it. And then 15 years from now, maybe you get to recapture it at 25%.
Yeah.
That's a win for you guys.
Yeah.
All right.
Okay, number 7 is don't sell, borrow.
Yes, I love this one.
What do we mean by that?
We all want to say something.
No, I want to let you go.
So is borrowing a taxable event? Is borrowing a taxable event? Does anybody pay taxes on borrowing money?
Nope.
No.
Okay, so this is the underlying incentive to why we want to constantly re-leverage up our properties instead of selling our properties, because typically our properties are appreciating not through just the inherent cost of the stones that it costs to build the property, but because of the rent growth, right? And the income associated with that. So years and years down the road, the income is going to grow and the property is going to be able to afford a higher debt service, and the property is going to inherently be worth more because of that. So when your loan expires, which is typically not a fully amortized loan, hardly ever, unless it's some government low housing or LIHTC or are Fannie Mae loans fully ammed?
Not usually. No, HUD loans can be.
So there's a balloon payment, 5, 7, 10, 15 years, whenever it is, the loan expires. And at that point, you're left with a decision to refinance or sell the property. And somebody should be doing a refi or sale analysis for you. And that is the one analysis you need to do post-tax, right? Because that's the staggering difference, in my opinion.
So I'll give you a real life example because we've done this several times, and this has absolutely changed my life. This one piece of advice here. We bought an apartment complex that was about 20% occupied for $1.5 million. Okay, and we spent, let's call it $500,000 fixing it up and getting those units ready for tenants. So now I'm in $2 million, right? But once I start filling those tenants up, the income's shooting up. And so 2-3 years later, I go to get a new loan and I get it appraised, and it appraises for like $6 million. And so I could have sold that property, and then I'd have to pay taxes on the $4 million that I made.
And profit. And it was like, it was longer than a year, but it was fast. I don't know.
It was longer than a year. So I would have had to pay 20% or 24 point something percent for capital gains over $1 million on that $4 million.
Correct.
So all we did was we said, hey, lender, can you loan me money? And they're like, yes. And so we appraised it at about $6 million. We got a 75 or 80% loan on it, and we pulled out $4.8 million. Let's just say it was something really close to that. And so now I was in for $2 million, and now I got a loan for $4.8 million. So I literally got $2.8 million in my pocket, zero taxes, zero. And
you didn't have to 1031 it.
Didn't have to do anything. I literally just put it in my pocket. I could go invest it tomorrow. I could go buy a house with it. I could do whatever I wanted to with it. And I hear some voices saying, "Well, Joel, yeah, but you got to pay the loan back." No, I don't have to pay the loan back, because if the property's appraising for $6 million, that means my income, my net operating income, is sufficient to repay the loan.
I'm going to blow everyone's mind. If anything, you not only didn't pay taxes on the $2.8 million, but by borrowing it, you incurred an additional expense, interest, to write off.
Yeah.
So that borrowing $2.8 million tax-free allowed you to offset even more income.
Yeah,
it's beautiful.
And so what's going to happen now over, let's say that loan is on a 25-year AM. What's going to happen? I got the $2.8 million in my pocket. Well, over the next 25 years, the tenants are going to pay that loan off to zero.
Yep.
Right? That $4.8 million is going to go to zero, and that property over 25 years is going to triple in value. Right? So then in 25 years, that $6 million property is going to be worth $18 million, and I'm going to owe zero on it. So who had to pay back the loan? Not me. Right? And all the while that this property is tripling in value, and the tenants are paying off the loan, I've got $2.8 million that I can go buy another $10 million building with that's going to triple over the next 25 years. This is hugely powerful, guys. Buy a property, let the value increase or increase it through renovation, and then don't sell it, keep it, right? Refinance it and take those proceeds and buy another property, buy another building with it, and keep the original property. Now your assets have doubled, and you haven't paid any taxes.
I think people refer to this as equity farming, don't they?
Something like that.
Yeah.
Anyway, we've done it successfully many times. It's one of the most powerful things we've done in commercial real estate is buy properties that need renovated, renovate them, get a higher value, let appreciation and inflation work its magic, and take 80% of the proceeds out through a loan and pay zero taxes. Okay.
All right. We're getting long. So number 8 is, and last one is die owning your property.
Gosh.
Why do you want to die owning your property?
We don't want to die, Ryan. We just are going to die.
Okay.
All right. This one's easy. And it's really, really interesting how the government has set this up. So if, let's say you have, and I'm going to use $1 million because it's just easy. You buy $1 million property, and then you're going to depreciate that, taking advantage of all the tax benefits, and you're going to depreciate that to zero.
You're going to incur that loss without actually spending the money.
Right. You're not going to, and the property's going to make you money. And now you're getting old and you're about to die. And you're like, I'm not going to sell that. I'm going to die and I'm going to still own it, but it's going to pass to my heirs. Okay. Well, what happens is, let's say that $1 million property is now worth $5 million. Okay. But you've depreciated it to zero. So if you sold it, you'd have to pay capital gains on $5 million, which the bill would be $1 million. Okay. But if you pass it to your heirs upon your death, they get a step up in basis to the $5 million. Mm-hmm. And so they could sell it for $5 million and take $5 million tax free.
Yeah.
Because the government allows you through an estate sale or through the estate when you die to give, I think it's up to $15 million now. I'm not on the exact number, but like $12 to $15 million you can pass to your heirs tax free. Yeah. So that is amazing, guys.
So it's everything over $15 million that you pay estate tax on?
That's right.
That's right.
Mm-hmm. And through a step-up basis, they don't even have to pay ordinary income tax, long-term capital gains tax.
I don't think so.
It's nothing. And there should be an inherent tax bill because you depreciate it to zero.
Correct.
But when you die, it transfers to your heirs and they get a step up on basis. And then what do they get to do? Like, let's say that $5 million property is making $500,000 in income every year. Well, your heirs aren't going to have to pay that because they can depreciate starting from $5 million down. And so the depreciation will most likely offset 100% of the income that property is making or close to it. So now they could choose to sell and take $5 million tax free, or they can choose to keep that property, let it keep growing in value, and take that income tax free, or at least mostly tax free, because they're going to start depreciating it all over again.
And then I'm assuming they would pay ordinary income and depreciation recapture from their basis the day they inherited
the $5 million basis.
Correct.
Yep.
Okay, that makes sense. Holy shit.
It's powerful.
That's good.
All right, those are 8 ways to maximize tax benefits or lower your tax bill. And guys, this is why we're in this game, because you can make a lot of money and pay very little money in taxes, and the government lets you do it. It's legal. Make sure you get the right advice. And if you have questions, hit us up, right? We covered most of it, but pretty high level. So you may have specific questions. Send us a message. Let us address it on the air on our next podcast. Braden, got anything else?
Yes, we wanted to thank everyone for coming out to the new investor networking event we had at the co-working space up in Owasso a few weeks ago. It was awesome. We got a lot of good conversations going there. We had some lunch, good times, hung out and talked for like an hour. Good. So we'll probably end up doing this every single month. So if you are interested in stopping by, make sure you are on our email list and we will get you plugged in.
All right. Thanks, guys.